And a top focus in beyond at this hour. Banking shares in Europe and the United States suffered another walloping Wednesday. This was led by the shares of Credit Suisse, the flagship Swiss lender, which tumbled as much as 30%. The bank was rocked once more after Saudi National Bank, which is its main shareholder, said it would absolutely not up its stake. Credit Suisse has now announced it is borrowing over $53 billion from the Swiss Central Bank. Global markets have been rattled by the collapse of the Silicon Valley Bank and Signature Bank, the sector's biggest failure since the 2008 financial crisis. Credit Suisse led a rout in bank shares in Europe. Its largest investor said it could not provide more financial assistance because of regulatory constraints. Swiss regulators pledged a liquidity lifeline to Credit Suisse in an unprecedented move by central bank. In a joint statement, the Swiss financial regulator and the nation's central bank sought to ease investor fears. They said that Credit Suisse meets the capital and liquidity requirements imposed on systemically important banks, but stressed that they were ready to make liquidity available if required. Hoping to quell concerns, the regulators added that there were no indications of a direct risk of contagion for Swiss institutions. Now, Credit Suisse welcomed the statement of support, making it the first major global bank to be given such a lifeline since the 2008 financial crisis. The bank says that it is taking decisive action to strengthen its liquidity. Credit Suisse is borrowing up to $54 billion from the Swiss Central Bank. Remember, central banks have extended liquidity more generally to banks during times of market stress, including during the COVID-19 pandemic. The US Treasury is monitoring the situation around Credit Suisse and is in touch with global counterparts. For some market experts, Credit Suisse sell-off shows the extent of market fears over the banking sector.
When there are concerns, people start to sell assets, and those that are forced to sell assets will be selling them at a discount, marking those assets down, generating more forced sales and creating this self-fulfilling spiral down to zero, which is what we're seeing with some of these banks that have to force sell their assets in order to meet depositors running out the door.
The Asian stocks extended Wall Street's tumble and investors bought gold, bonds and the dollar, leaving markets on edge ahead of a European Central Bank meeting. Experts say that the traders' bets on a large European Central Bank interest rate hike have evaporated. The money market pricing suggested that the traders are no longer optimistic about a 50 basis point rate hike at the European Central Bank meeting, which will take place later today.